Hello and good morning. My name is Mark Hamza Arabogbo. I am the chairman of the FANG, Financial Executives Networking Group, Capital Markets Special Interest Group. Our conversation today will be on executive benefits, executive compensation, corporate governance, and the future of defined benefit contributions, featuring Teddy Awuah, Serena Sneeringer, Marcellus Upshaw, and Peter Hornton. And Teddy, if you could go ahead and introduce yourself.
Sorry about that. Needed to unmute myself. My name is Teddy Awuah. I work with a group of specialist retirement plan consultants here in Houston called Qualified Plan Advisors. We manage over $6 billion of assets in over 90 retirement plans, most of which are here in Houston. Started in the industry on the sales, corporate sales, wholesaling side of things back when, I guess the calm before the storm, if you will, in 2008. Slowly migrated, if you will, to the retirement plan services and worked as a consultant on that side and also sales and service. And then recently, over the past 6 years, made the migration to be an advisor, if you will. Excited to be on the call today and to add my knowledge and my, I guess, my expertise, if you will, in the area of defined contribution.
Excellent. Thank you. Serena, if you can introduce yourself, please. Thank you.
Sure. Thank you, Mark. My name is Serena Sneeringer. I'm a financial advisor with Wells Fargo Advisors, officing in the Houston Galleria office. Started out in the industry 11 years ago on the recruiting side, used to recruit advisors to another major wirehouse firm, and then got into the firm as an advisor. Been an advisor for 6 years and help a lot of business owners, women, and families do legacy planning. Thanks.
Excellent. And Peter, if you can go ahead and introduce yourself, please.
My name is Peter Horton, as well with Wells Fargo Advisors. Started in the business in 2008, which was always an interesting year, right, to begin in the business. But Serena and I are partners together, and this really what we try to do is help our clients live the one life that they have, the best they can without undue risk or financial stress. And we just try to find the most efficient, effective ways for our clients to do that. I'm excited to be here. I think this is a really neat group, and I think it'll be a fun discussion.
Excellent. And last but definitely not least, Marcellus.
Yeah, thank you, Mark. I'm honored to be on this panel here, distinguished professional. So thank you for the invitation here. I'm Marcellus Upshaw. I am with Bernstein Private Wealth Management. It is a global research and investment management firm. I am one of the advisors here locally who works with business owners and executives as it relates to their finances and helping them to understand how to transition wealth, not only from their current generation, but to get it to 2 or 3 generations removed. So a lot of the conversations that I'm having with clients involves not only the investment management component, but a lot of the things that most people are starting to think about is what am I missing in the market and how can I improve my current situation? So looking forward to contributing on the executive compensation component of this conversation. And thank you for having me.
Excellent. Well, and so we'll be starting off with a brief presentation with Peter and Serena from Wells Fargo, and then we're going to go into a fireside chat. I encourage you to prepare and ask your questions, put them in the chat, and we do have, and if you would like to ask your questions, just feel free to put them in the chat and I will moderate them for you. So Serena or Peter, if you would like to share your screen.
Sure. Sounds great. Well, let me get that for you. And so I'm going to switch screens over here for you. So I hope, is that coming through okay? Can everybody see the screen there?
Yep.
Great. Good. So I like that. Sometimes when you have that, I was told earlier my Zoom, we've all gone through this Zoom transformation. That's called bad radio when you have dead silence there. So I apologize about that. But really what we're going to talk today about was executive compensation. Mark brought up, said, Peter, what do you think is something interesting going on right now that we can have a 5 to 10 minute conversation about to start the meeting? And what is something that maybe is somewhat unique? You might have heard about this before, NUA, net unrealized appreciation, but what we would like to do is go over this for about 5 to 10 minutes to start getting your brain thinking about some different ideas, and then we'll go into the fireside chat to get into some other ideas as well. But it comes down to what is net unrealized appreciation, and that's usually the first question that we get asked. But before we hop into that, we always have our disclosures, right? And so to do any strategy, net unrealized appreciation, if you're looking at doing some charitable work, Marcellus talks about doing some deep planning. I think it's really important to talk to your tax professional. We have specialists on our teams that deal with net unrealized appreciation. We have a CPA on staff who helps with that to make sure we execute it properly. And so I think it's really, really important to do that. So going into the presentation, what is net unrealized appreciation? So, and feel free to ask questions as we go along too. I don't know if you have noticed, but markets are at an all-time high or close to it. We've also had certain industries do very, very well. And there's some concerns about taxes and the implications of what tax rates might go or capital gains rates where they might go. And so one strategy that we're having a lot of conversations about is the net unrealized appreciation. And basically in general, if you can think about it, is what net unrealized appreciation is it's looking at the cost basis if you have, and a lot of executives, because this is really geared toward executive compensation, a lot of executives have their company stock inside their plan, their 401k, or a employer retirement plan. And there's a basis of that stock. It's been something that's been kept up. And so Serena has a client that we teamed up together, and she introduced me to, and we've been working with, and it's amazing. I think, Serena, you can tell me if I'm right or wrong, if I'm off the top of my head, but I think the cost basis of their Microsoft stock is somewhere around $2, $5.
Sure. Yep, 192.
192 for Microsoft stock, right? They nailed it on the purchase, right? But let's think about that gain that's happened in that employer plan. So one option is they can take out that money and pay ordinary income on the full amount of that growth. The other option is utilize this net unrealized appreciation, which means you only pay ordinary income tax on that basis, that $2 or $1.98 basis. All the gain that's happened since then would be on a capital gain basis, which is typically a lower tax rate. And you may think, well, what's the big deal about that? Well, if you look at 10 to 12,000% on top of $300,000, sometimes $400,000 or $500,000, that's a significant amount of tax savings. And so it's an idea that you can use for a couple of different things. One, lowering your tax rate. Two, for charitable planning. Or three, also looking for your estate plan. So we're going to go into a couple examples, but first a general rule. A general rule for this, a general rule for this is that, remember, everything that comes out of your employer plan typically is distributed at your ordinary income basis. The capital gains rate is typically a lower basis. Something you need to look at is with your tax professional to kind of see where you fall in line with these. But that's just the general rule that we want to start off with. And the other thing that you need to realize is that this NUA doesn't last forever. You can lose the treatment for that. So what I mean by that is if you directly roll over from a qualified retirement plan, your assets to an IRA or another qualified retirement plan, the great news, and Teddy can talk a lot about this being an expert in the defined contribution plans, the great thing about this is you can do this rollover with no taxes. Right? But when you do that, you do lose the ability to choose later if you want to do net unrealized appreciation. So it can be lost. And so what I hear about is when you say, okay, Peter, when you say lump sum distribution, what is that? What is a lump sum distribution? Can you define that? And what a lump sum distribution is typically when you hit the age of 59 and a half or afterwards, when you leave your company or at death, you have the ability to withdraw from your employer plan. These are really the times and decisions that you should be looking at. Does a net unrealized appreciation make sense for me? Anytime before the age of 59 and a half and you're still employed at the company might not make a lot of sense, right? The things that I think are interesting about this is, so why would you do it? What are you thinking about? I don't know if you have in this business met a lot of entrepreneurs over the past 18 months, but I feel like a lot of people maybe transitioned out of their last job or got laid off and they needed capital to start a company. Well, this is a great way to use some of the benefits that you had from your low cost basis that you might have had in a company stock, transition that and make a larger, instead of just withdrawing the money out of the 401k plan or employer plan, withdraw it at a lower taxable event, which now gives you more capital to invest in this company. Or what about also maybe it is when you retire that you would like to still keep your home, but buy a second home or a ability to also give to a donor advised fund. So let's remember, if you contribute to charities or like a donor advised fund, you can contribute your stock. But what's great about this, and we'll go into this in more detail, is you paid ordinary income on the basis. You haven't recognized the capital gain yet because you haven't sold it. And now with that larger dollar amount, you get to contribute to a charity and get the write-off off the top dollar, and all that gain never got realized as for taxes. So let's just run an example on this. You have a contribution of maybe a cost basis of $10,000. The stock is worth $100,000 now. You take the money out of your plan using the net unrealized appreciation. You pay $10,000 of ordinary income. You send that stock directly to a charity of your choice, maybe a donor advised fund, and you just now have $100,000 deduction. Maybe you can't take it all in 1 year, but maybe you can take that over the 5 years of the allowable carryover for that. So there's a lot of things that you can do with net unrealized appreciation that might not have been thought of before. And so I'm going to give you a couple of examples, some do's and don'ts again in the next 3 minutes or so, and then we'll have more questions if there are, and we'll go to that fireside chat. But just let's look at one case study, and we're going to go through 3 different scenarios just to make sure you understand them. All the these case studies all have the same scenario. We execute it in 3 different ways. So there's a participant that has 10,000 shares of her company's stock. There's $40,000 that basically think of it as cost basis. She retires at 65 and now it's worth $100,000. So what can she do? What are her options? Well, the first option is that she transfers the stock into an IRA or sell the stock and transfer it to an IRA. So what's going to happen is she transfers the stock to an IRA or the cash to an IRA, what is great is you're not going to have any kind of current year income tax implications because of that. It's basically called a direct rollover. Everything in the future will be treated as ordinary income when she takes it out of that IRA or that qualified retirement plan. She could roll it over to a Roth IRA as well. That's called a Roth conversion, and we can talk about that later. I think it's a great idea and can be used in really good implications. But when you do that, remember, you're going to pay tax on that full $100,000 at that conversion. And that net unrealized appreciation is no longer eligible. So because you rolled directly into an IRA, you have lost the ability to do net unrealized appreciation. So same case study, what happens if you transfer the stock into another qualified retirement plan? You didn't sell it, or you did sell it. You could transfer the stock entirely, or you could sell the stock. What's the differences? Well, you still have the ability, if the new company allows you to roll the shares into the qualified retirement plan, maybe you've got a new job, you're not going to pay any kind of income tax. Still looks like a rollover on that transfer to a new qualified retirement plan. But however, even though you're still in a qualified retirement plan, you're not able, because it wasn't with the original employer, to do that net unrealized appreciation. So just because you transfer the shares from one IRA or one qualified retirement plan doesn't allow you to do that net unrealized appreciation. So if you want to do that later, that option is lost. So let's see how this can actually be executed. Let's say you take your stock and you distribute it out of the employer plan directly to an IRA, a non-IRA brokerage account, excuse me. Then you sell that stock and pay taxes on the gross proceeds. So how does that work? So you basically took the employer plan, your 401k, if you call it, if it's that, and then you move it into a taxable investment account. And it could be with any firm or anywhere. And then you sell it. Just make sure we're on the same page there. What happens is you pay ordinary income on that cost basis of $40,000. So the great news is that $60,000 can qualify for net unrealized appreciation. And that can be taxed at a capital gains rate. So the other scenario is maybe you just don't sell it. You just pay the capital gains rate later when you sell. Let's not sell now. Let's take it as ordinary income, and then you can sell a little bit later if you decide to do that. So you have a couple of different options on how you can use net unrealized appreciation. I think it is a tool that has been overlooked over the years. And I think for simplicity reasons, it's always easier just to roll the 401k and not have to worry about it. But what I would tell you is take a little bit of time, a little bit of planning, and if it makes sense for you, you can save yourself a large tax bill, or also maybe plan with, like Marcellus mentioned, doing some planning for your future generations, or you could also look at charitable giving. That's something that you might have a great passion about. I know you just received a lot of information in a very short amount of time, but we wanted to get just the thought process and some different ideas going for you when we were talking about specifically executive benefits and things that pertain for executives, especially in the Houston area with as many large employers that we have here. If there's any questions, we'd be more than happy to answer them. If not, we can always go straight to that fireside chat.
Right, excellent. Wonderful. So yeah, folks, if you can kindly, if you have questions, let's make this as interactive as possible. And so let's go straight into the fireside. So Teddy, how you doing?
Doing great. How are you?
I'm great. Looking sharp. How was the Astros game the other day?
That was great. I'm glad that we were able to rebound. Yesterday, I felt like the heart of the lineup was able to settle down between Altuve and Correa and Bregman. So we're looking forward to hopefully getting at least one victory in Atlanta.
Okay, fantastic. And that was not your question. So anyways.
Okay.
Super. All right, folks. So let's get into this. So as I tell you, the Secure Act of 2019 has been labeled by experts in your industry as the most consequential law in the retirement plan space since the Pension Protection Act of 2006. Why do you think this is the case?
Yeah, Mark. So going back to the PPP, the PPA, if you will, of 2006, that was a true focus on really automatic enrollment and making sure that employees of retirement plans were giving the opportunity to join plans, right? So that was kind of the landmark focus from an investment option standpoint or investment menu standpoint. Asset allocation target date funds became a focus in 2006 through the PPA, right? So what we've seen from that time till now is, where we had 20 to 30% of assets in what they call target date funds, which we'll talk about a little bit more in detail later on. That's definitely evolved to be kind of the main area of focus, if you will, from an asset allocation standpoint for participants in defined contribution plans. The reason why the Secure Act is such a big deal is because between 2006 and now, there hasn't been anything that has had such consequence in terms of inclusion and making sure employees have access to retirement plans. So what do I mean by that? So it's estimated that somewhere between 40 to 60% of 120 million of our American workers don't have access to a corporate retirement plan, right? So where automatic enrollment was a great start, the Secure Act was really focusing on making sure that 40%, if you will, and some of those are gig workers, right? The world has changed quite a bit since 2006, have some type of access to saving for when they don't want to work anymore. So we start to talk about pooled employer plans and allowing companies that don't have any relation to come together and create an economy of scale and allow employees to actually participate in the plan. For employers, it's always been, well, I don't understand, how I'm going to administrate this plan. I don't have the resources, depending on how big you are, right? You have one person that's wearing 5 or 6 hats, right? HR, CFO, they're doing everything. They're opening up doors and all kinds of stuff. So in the small plan area, or the small business area, I should say, the PPP, or the pooled employer plan, if you will, that came out with the Secure Act, gives folks an opportunity to go ahead and combine their assets with other smaller employers, generally speaking, and offer a retirement plan where it's a turnkey solution administratively from an investment menus standpoint, and then also from a cost standpoint, because there's an economy of scale by bringing different companies together. So that's one thing. The other thing I would say is there's a new regulation or through the Secure Act, folks that have worked at least 500 hours come 2023 are going to be eligible to participate in a 401k plan or a defined contribution plan, if you will. That's a big deal. The most restrictive you could be before the Secure Act is you got to be 21 and you got to work at least 1,000 hours a year to be a participant in a 401k plan, let's just say that way. That's all changing again because of the Secure Act and the desire to make sure that, again, 40% to 60% of the working corporate population have access to a retirement plan. They want folks to be saving because there is a significant gap in terms of what people should be saving and how much they are saving. The other thing that was a big deal for the Secure Act was providing an income solution for baby boomers, right? So we have about 10,000 folks in this country that are retiring every day between now and 2030. And they need solutions as to how they transfer their wealth, right? Which I'm sure Marcellus and Serena and you guys, are talking about that with individuals on a daily basis. But in the meantime, the defined contribution industry is focused on finding ways to help them have more options to, I guess, slowly draw or withdraw or take from systematically their pot that they've built up with their 401k account that they've built up over a 20, 30-year career. And they've created some safe harbors that would allow you to transfer your account if you so chose to invest in something like an annuity that's within a 401k plan, let's say. You can now go from, let's say, a Fidelity to an Empower to a John Hancock to a Nationwide without there being any type of issue with that account transferring over if you did decide to invest in an income product or income solution within your 401k plan. So there was a lot of other things that was talked about in the Secure Act, but I would say inclusion for employees, and then also providing safe harbors for plan sponsors, and also providing opportunities for employees to start to think about that distribution and how they're going to manage that in retirement.
Excellent. Thank you for setting the bar really high there, Teddy. So we got an encyclopedia here. All right, so Marcellus, we often see reports of company executives making a lot of money in the news. What typically makes up the compensation package for an executive?
Yeah, sure. And I'll take the approach of speaking from a publicly traded perspective. Generally, what you're going to see with executives is some form of cash compensation and equity compensation that makes their total compensation. And so the cash component may have short-term incentives. There may be metrics or performance metrics that they are targeting in order to receive a bonus or annual cash payout for that year. And then when it comes to equity compensation, you'll be looking at things that are more in line to put the executives on the same path of interest as a company and want the company to continue to grow, whether that's earnings, revenues, whatever the metrics are that they'll use for performance. That's where it creates an alignment with the executives and the companies that they represent to have an incentive to do well there. So generally speaking, between both of those components, there's a component that's current compensation and deferred compensation. And I'm sure we'll hit on those different components and buckets throughout this conversation. But essentially what it does is it attracts executives to companies to also help with the retention of keeping them invested in the company and wanting the company to be profitable. So generally, when you're thinking long-term incentives, you're typically performance-based awards are about 50% of their compensation. And then there's usually a mix of stock options or restricted stock that's granted to them as a form of their compensation. So that's the high-level overview of it.
Excellent, thank you. And so, Serena, I understand a lot of executives have a lot of their wealth concentrated in one stock position. How much would you say is too much?
Well, the answer really depends on each individual's plan, overall. So you have to look at their entire investment portfolio, their goals, their liquidity needs, their time horizon, and also their risk tolerance. So for one person, it could be 10%. For another, it could be, 30 or 40%. It really just depends on their overall investment portfolio. So planning it plays a key part in that. I think, there's some things that you can do if you do have some concentrated stock in your overall investment portfolio and feel that you have too much. You can, simplest answer is usually the easiest, spread out the gains over a period of time and just sell a little bit each year. You can also write option strategies. There's some alternative strategies where you can put a big portion of it into another investment and delay the taxes on that, or minimize taxes. And you can also do some estate planning or charitable gifting strategies with concentrated stock. Short and sweet.
Thank you, appreciate it. And Peter, in today's competitive employment environment, how can companies provide added benefits to key employees?
Well, that's a good question. I would say one of the biggest ones that we're doing right now or see people use is non-qualified deferred compensation. It's one of the plans that you can do for executives that is kind of like the wild, wild west still, right? You can still make a lot of the rules very wide and broad. So basically what it does is if you believe tax rates are going up and you're a highly compensated individual and you wanted to defer money, you could do that through a non-qualified deferred compensation plan. And I think they're great, but you have to also remember, you know, who they're for and what they're there for. You can basically defer money as an executive, but also if you're an employer, you have the ability to do some of the golden handcuffs, right? You can do you can contribute as well into that plan for that employee, that key executive employee, and put a vesting schedule on it. And each year, when I said it's kind of the Wild West, you can change that vesting schedule if you add new contributions to it. And so you can do a lot of incentive programs, but also try to retain those key employees. And it's really for those key employees that those plans are set up for. So that's something that you're seeing more and more companies with 100 employees starting to participate and to keep those executives. So.
And I'm going to throw a quick question out to the audience, and folks, please unmute yourselves. We have some CFOs in the audience. How many employees are you working with at your organizations? Larry or Mark, Hacken, maybe Stefano, or perhaps Gary. So Larry's got about 100 employees. Okay, interesting. Jared, Edwin, Susan, 12 now, 40 before from Harkin. Okay, interesting. And Anne, Victor, Eileen, 80. Okay, Glenn, Mark Norick has about 80 employees. Okay, yeah, great, fantastic. Okay, superb. So we just want to get this a little bit more different meaning, hence no camera. No problem, 18 from Glenn. All right, fantastic, superb. Just so we can get a bit of an understanding. And then, so Teddy, talk to us about how private equity in the asset management world is becoming more of a talking point with plan sponsors.
Yeah, I think historically speaking, private equity has obviously been, reserved for a very small subset of the population that is an accredited investor, right? There have been discussions, as of late or in the recent years around how do we enter that, or how do we, provide that to participants in retirement plans. And really, what we've seen over the past couple of years is that the Department of Labor has given us, as consultants, an opportunity to introduce this to plan sponsors. But they've done so in a way that you can't actually pick an investment where it's just fully private equity companies that are in that mutual fund, let's say. The only way that you can really focus on private equity or try to include that type of private equity option is to look at a target date series. So that's through the guidance of the SEC and the Department of Labor. We don't want to provide options for participants where, in a given year, you could gain 50% and lose 50%. That goes against the onus, if you will, of offering a retirement plan where you want performance and consistency over a long period of time. So we're really excited about the guidance that the Department of Labor and the SEC has provided, and being able to have a sleeve of private equity in target date funds, which target date funds are funds that focus on one's ability to retire at a certain date, and you're hiring an investment management company, if you will, to manage the glide path or the equity, fixed income, and cash allocation for you to get you to retirement. So.
Mark, you're muted. We can't hear you.
That's my special Zoom trick. Thank you. So Marcellus, as an executive who's receiving equity awards, what are some rules or restrictions that an executive should be considering?
Yeah, there's going to be two components to it. There will be regulatory rules that you'll have to follow. Those are set by the SEC, and then there's company rules that you'll have to consider. So when you think about regulatory rules, there's things like Section 409A, where you have to have a plan in writing for participating in some of the non-qualified plans like Peter mentioned. And then there's Rule 144, where it does take into account the period of time that you owe the security as far as being able to sell it. That's generally going to be subjected to holding periods, trading patterns, and volume, and company reporting requirements. And then with public executives, you're also considering Section 16, short swing. Basically, you have to be very cognizant when you're making a purchase or sell of a security within a 6-month period. And then there's a couple other strategies. This is more along the lines of thinking about diversification and/or tax strategies, which you always have to consult with your tax professional, accountant, or legal representative for advice on those things. But the 83B election allows you to do things where you can pay taxes up front on a stock when stock is granted to you, and allow for the appreciation to occur afterwards by setting your cost basis in that current year. So that and a 10b5-1 plan is where you have an outline plan to sell security. So oftentimes that actually plays into company restrictions where there may be blackout periods and holding requirements where you're able to clearly forecast and communicate periods of time when you intend on selling stock. When you're an executive at a publicly traded company, oftentimes what you're doing can be an indication to the market. So typically as an exec, you're being cognizant of the perception that can be taken away from you selling securities of your own company.
I'm on mute again. Excellent, thank you. And Serena, tell me more about estate planning and charitable techniques.
I think Peter mentioned one earlier. So I think you mentioned the donor advised fund. So we've seen a lot of clients use this. If you have stock that has a cost basis of, let's say, $20,000, it's valued at $100,000 today, there's an $80,000 taxable gain on that. So you can put it into a donor advised fund, the full $100,000, get a tax deduction, and you can spread that deduction over 5 years. So if you can't use the full thing in year one, you can delay that or do a little each year. And then you can turn around and give that out to any charity that you choose, and there's no limit on the number of years. They like you to keep it in for usually at least a year before you gift the entire thing out. But you can write checks to any charity. And I think that a lot of families are setting these up. It's kind of like their own personal foundation. There's a lot of rules and regulations and administration that go with a family foundation. So we're seeing investors use this tool. You can also gift required minimum distributions. So at 72, you're required to take out a certain amount from your IRA, and the IRS wants you to pay taxes. So you can take that RMD, as we call it, and gift that to your church or a charitable organization of your choosing. and not owe ordinary income tax on that. Keep your modified adjusted gross income down that year. There's other strategies. This one gets a little complicated, but it's a charitable remainder trust where you can actually put the full 100,000 into a trust and you get your deduction that year, and you can purchase an irrevocable life insurance trust within that. And the distributions that come out are gifts that you would give to your children to purchase this insurance policy. Basically, they're getting a pool of insurance at the end of your life that they can use that's tax-free to pay off any taxable inheritance they receive. It's another strategy that, you know, families can use if it makes sense.
Excellent. Thank you. Great answer. Peter, who benefits from non-qualified deferred compensation plans?
Yeah, that's a great question. So, you mentioned that I would say it sounds like a lot of the CFOs in the room are between that 40 to 100 employees, and there was a couple maybe above 100. I think the employers that have more than 100, and just say, let's use a ballpark number. This is not going to be exact, but you can only use it for your executives, right? It's executives. It's about 10%. You can say 10 to 15%. So let's say if you have 100 employees, you can use this for about 10 of those employees. And it's really supposed to be used for those employees that you're trying to keep and be highly compensated. You know, think about $100,000 or more. In Teddy's world, it can also be somewhere around $130,000 or more. So it really looks at the compensation structure of the company. And it's a case-by-case basis, and you want to be making sure the flow going into these plans, for it to make sense, needs to be around $50,000 a year at least. And so if you're not hitting these $50,000 minimum flow, meaning the employer and the employee contributions combined, then I'd say it probably doesn't make financial sense for the company to do that. But if you can hit the check boxes on most of those, and also C Corp, if you're going to do employer contributions, being a C Corp also helps as well. So there's a couple of little definitions and boxes you want to check. But as long as you have those checked, I think it's a great tool to explore and take a look at.
Excellent. That was a really great answer. Thank you, Peter. Teddy, do you have any thoughts on that as well? On the same question, who benefits from non-qualified deferred compensation plans?
Matter of fact, I do. I'm thinking of a specific kind of a quick little case study scenario that is a real life scenario that happened with me with a company that had about 2,000 employees. Yeah, they were looking to start a retirement plan, and in this case, they were a cleaning organization, right? So think cleaning emergency rooms and hospitals, if you will, in the Houston area. A lot of, low paid, if you will, rank and file employees that weren't making a ton of money, if you will. And then they had about 8 regional managers or so. The problem that they had in this particular case in terms of offering a 401k plan is if you have more than 100 employees, you actually have to have an audit, right? And that audit can be quite expensive, right? That audit is somewhere between typically $12,000 to $15,000. And then they weren't passing, non-discrimination testing. So there's some basic testing that has to be done in order to offer a qualified plan, to be qualified, if you will, as a 401k plan. Long story short, they didn't have enough coverage. They didn't have enough participation. And because of that, they couldn't offer a 401k plan. So I came to the conclusion that the best option for them would be a non-qualified deferred compensation plan for, the C-suite and for management personnel, as Peter was kind of alluding to. So in that case, they decided to go that route, offering a plan really, and that's who they really wanted to offer it to in the first place. They wanted some type of option, if you will, for the executives or for the highly paid employees. So that's just an example of how that plays out in a real life scenario where you can't typically offer a 401k or some type of qualified plan, then you need to look at the non-qualified world for C-suite folks.
Thank you. That was a really good answer also. A great case study as well. Thank you for sharing that. And so what are the top two topics or concerns that plan sponsors are bringing to your attention as it relates to their retirement plan strategy, financial wellness, and cybersecurity?
Yeah, so that is exactly that. Financial wellness and cybersecurity are the two things that that folks are kind of bringing up nowadays. This past year, we went through the big freeze, which we haven't had an event like this in Texas. I'm here in Houston, Texas. We haven't had an event like that in over 30 years, right? So I had a friend of mine that was part of a committee who had reached out and had talked to me about what they were doing for their employees. They had created a fund, if you will, to help their employees get through that time, if you will. They created an emergency fund to help them, manage their crisis. And it was an overwhelming response that they ran out of the funds to be able to pass out to all the employees. And financial wellness came up. It was just a natural conversation that happened. And what he really liked about the aspect of financial wellness is being able to have an emergency fund for every single one of the employees, right? Where they could defer, whether through their retirement plan or outside their retirement plan, working with an outside credit union to make sure that every employee would be able to defer up to, let's say, $2,000 for emergency purposes. If something like that would happen in the future, they would have access to that. So with the financial wellness program, that would be one of the main initiatives, is to make sure that you have, or your employees have, some type of emergency savings. We know that, I think the statistic is somewhere around 111, 110 million folks in this country don't have at least $1,000 to put away for an emergency, right? So that's a real life scenario. And this was an insurance company. So they had buckets of money sitting around, if you will, to help out their employees. And it was just a tremendous ask for the company to be able to help everyone out. They wanted to. And then, as you can see, the need to have a proactive, comprehensive financial wellness program made a lot of sense in that case. The other thing, real quickly, is cybersecurity, right? I think we all know that in the world that we live in today, that is a pressing issue. So if you're an advisor, or if you're part of a committee, if you will, and that isn't being talked about from all your vendors, whether that be a record keeper, advisor, third-party administrator, it's a big talking point right now, and making sure that you have, or that you're working with folks that have the proper, if you will, due diligence process behind the scenes to make sure that they're protecting clients' assets. So that's another big deal.
Excellent. Thank you. I appreciate that. And so, Marcellus, what are some strategies that can help with diversifying a concentrated position?
Yeah, yeah, absolutely. Good question. So generally you have 4 different things you can consider. Well, I guess maybe 5. 1, you can just hold on to it. That doesn't help with diversification, but that's an option and strategy you can take. 2 is to sell the stock. You can sell it outright. There's, I think Serena had mentioned different option strategies that you can utilize. And that also plays into being able to do something called like an exchange fund. That is more of swapping the stock out. Has certain requirements on it. It also has to, you have to have a certain amount of liquidity, and that stock itself needs to actually be something that the exchange fund would accept. But it'd be a means of swapping a concentrated position into a fund, and then after a 7-year period, receiving a diversified bucket of stocks from other people who have contributed their stock to the fund. So that's another way. Gifting was one way that was mentioned as well. This will take into account your ability to give to a donor advised fund, charitable remainder trust. If you're going to do a private foundation, whatever that looks like, there's different variations of the amount of tax deductibility that applies when you do a gift. based off of if it's short-term capital gains or long-term capital gains, and whether or not it's going to a public 501c3 entity or a private foundation. And so those are conversations you'll work with your advisor on, you'll work with your tax professional on, certainly, to have a good understanding of how to do that. And the last way you can think about diversifying is to use hedge strategies. And that may be something where you use collars and you or maybe limiting the downside while putting a cap on the upside and keeping that stock kind of within a set range of expectations. And for those who are looking to have liquidity, there's a method called a prepaid variable forward. And those are contracts that allows you to tap into some liquidity while being able to use those funds to diversify. And there's a means of settling the contracts some months out, depending on how long the term is. So few different ways, Mark, but it really, each scenario, it's going to be very dependent on your particular financial situation.
I appreciate those 4 tactics. I know you played, is it professional, semi-professional ball?
Yeah, basketball. You gotta have a plan, you know. The one thing with all of this is knowing the destination and having someone that can ride co-pilot to keep you on path. There's a lot of things that can distract you along the way. And to the extent you can stay on the path and take the path that has the highest probability of success, you're generally going to be pleased with the outcome.
Excellent. Thank you. Appreciate that. Sound like some basketball plays right there. All right. So Peter, how you doing? You good?
Doing well. Yeah.
Excellent. So what are one of the biggest mistakes you see with executive compensation?
You know, I would say I'll look at this from 2 different standpoints. You have the employer and the employee, right? So I think we have some CFOs that I heard you mention. I'll tell you from the employer, a lot of times, especially we're talking about smaller employers, you know, publicly traded, it's a different deal, but smaller employers, let's say 250 or less than employees, I see them do things that they're doing it out of the good of their heart, and they'll do things of like equity grants, especially think of like a private company. They're giving maybe some shares to some executives, and the idea is they will never leave and go become a competitor if we do this. Well, what can become a problem is if they do, and then all of a sudden they have 1 share, and at any time they can ask for financials when you have financials, right? And so you get in a situation where you do have someone who's your competition. There wasn't a set, and this happens all the time, there wasn't a set buyout agreement or evaluation, because most companies aren't doing full evaluations every year because it's quite expensive. I mean, Teddy just talked about doing, if you just do a 401k audit, it can be $15,000. If you do a full company audit, it can be very similar or even more, depending on how complex that company is. And so you don't want an executive to leave and then all of a sudden, at different times, be able to get your financials because now they're an owner. And that might not be something you want to share at all anyway. So there's some options like employer stock appreciation. You might hear them called SARs. It's still allowing them to kind of participate, and you get to have that feeling of an ExxonMobil, a Schlumberger, a Microsoft, a Texas Instruments. By if revenue goes up, they get to get cashed out on those type of appreciations, but they don't have to go through. It keeps things more confidential, and there's other options there. So I would say that's one from the employer side. I tell you from the employee, and this is amazing. It's truly amazing. There was a study done in 2018, Serena, you can correct me if I'm wrong on this, but it was done by CNBC, and something like around 24% of vested stock options that were in the money. So in the money stock options were left on the table and expired. And they said, and not every year, but 24% of the people who have had stock options have had some expire while they're in the money and never. And I get it. You're an executive. You're a busy guy. You have a family, maybe. You might have children, and you're working 10 to 12 hours a day, you're busy, but and a lot of times, well, I'm gonna wait till the last month before I exercise these stocks. Well, or these options. It helps to have someone who's kind of looking over your shoulder to make sure those things happen for you. And the last one, I think Marcel spoke a little bit about it, Serena, is just having concentrated stock positions and not having a strategy about it. I hear more people just say, it's the way it is and I can't do anything about it. And the truth is there's multiple things you can do about it. I think that's something that's huge. And I would say third and last thing about the individual is I see a lot of executives invest in something, and I don't think this is wrong, but I think you need to be clear on it. I call it garage private equity, right? I know Marcellus is seeing this all the time as well, and Serena and I have seen it. It's the investment of a buddy, and it's private capital that maybe it's a company in equity, it might be a debt deal, it might be a real estate deal. And I think those things are fine, but you have to understand what you're getting into. It's a different level when you do institutional private capital. Typically with the institutional private capital, you're not going to be hitting home runs with it. It's just consistent, relatively higher rates of return by giving up a little liquidity, right? And if you understand that, then you can do well. And there's nothing wrong with garage private capital. You just have to understand those are two different ones. Microsoft started out of a garage, right? So you can do great on that, right? I'm not knocking it, but you just got to kind of understand the differences in the private capital market. And I think it's a difficult thing to get educated on that. I think, Mark, you have a lot of experience in private capital. I think that the too quickly executives go into what I would call private capital without really understanding what exactly are the pros and cons and understanding what you're trying to accomplish with it. And the two things that will make you have bad decisions every time with money is fear and greed. And you got to find out if it's fear or greed that's motivating you. If it's one of those, then you maybe need to think, am I doing the right thing? And having a person maybe just have a conversation with a person to figure out if you're going in the right direction there. And if you're making a wrong decision based on a human instinct. So that'd be my answer to that.
Great. And folks, I'll throw this out to all of you. How do you counsel your clients when you see them, and how do you determine they're moving out of fear or greed? And when you do see that, what techniques, maybe this is more emotional quotient, do you use to counsel them? Serena.
Fear or greed? I think for us, we focus on the plan. So for all of our clients, they have a written documented plan. We take into account their Social Security income, pension income, rental income, oil, checks, mineral checks that they get. So we kind of take into account all of that into their plan. But more importantly, I think for Peter and I, we really have gotten our planning process down to a one-page document for clients, and they really like that. I mean, we still do the, robust Monte Carlo financial, 80-page planning software tool that we use, but we limit it to a one page and really prioritizing, their most important goal, whether that's paying 100% of their child's college expenses, maybe it's buying that, $2 million ranch out in the country or starting their own farm, whatever is most important to them, and prioritizing their top goals. And then maybe they have some lower priorities here at the bottom. And so if fear or greed step in and the market's doing some crazy things, or they heard about a great opportunity, we say, hey, if you stick to your plan, for sure you're going to get these ideal priorities, number 1, 2, 3, 4, and 5, without taking on any more risk. If you want to take on more risk, you can, we can do that. But I think it's really about what is this money for? So for a lot of individuals, and, Peter and I probably made this mistake early on too. We thought our goal was to get the pile of money bigger, but I think in reality, it's what is it for and who is it for? And when am I going to gift these assets to my family? or when am I going to gift them to my alumni or my church? And so I think just sticking to that written plan is most important when it comes to fear or greed.
Great answer. Teddy, same question.
Yeah, I think it has to be part, from my perspective in dealing with the employer or the investment committee, you have to factor that into the equation. But more importantly, you also have to factor in what is the goal? Like, what are we trying to accomplish? Which the center of that question is around the employees, right? Helping them, become more retirement ready. So everything that we're doing has to be from that perspective, whether it's the design of the plan, which I'll talk about in a bit here, or our education, right? What does that look like? We talked about financial wellness, or an investment menu and the design of that and the monitoring process of that, or are we considering bringing on other third parties to help out, in executing in any of the previous things that I mentioned? And then also the ERISA fiduciary side, of things, which is forever changing, right? Which is why I have a job. So with that being said, it's always about, Serena alluded to this, it's always about what are we trying to accomplish for the employees? And then at the same time, how does that benefit the company overall and the bottom line of the company, right? How's that helping the company overall?
Superb. Marcellus, from your point of view, how do you mitigate fear and greed?
Yeah, absolutely. And the approach will incorporate a lot of things that have already been said. But when I'm looking at fear and greed, we're generally looking at what is the plan. So we typically like to delineate assets into two buckets here. You're going to have your core assets. These will be the assets that you need to sustain your lifestyle for the remainder of your life, the spending, gifting, things of that nature. Then you have your surplus capital. Everything that's in surplus, that may be for future generations, it may be gifting, or you could spend it. Generally, you're going to have four places that your money can go once you start to get towards the end of your life cycle. You can either spend it, the government can take it, you can give it to charity, or you can give it to your family. And so figuring out and prioritizing which one of those things you want at number 1, 2, 3, and 4, or maybe even for a lot of people, they don't even want the government to touch the money at all. So they figure out a way how to give it to the family and to charity. Having those conversations up front, having a clear plan, as I had mentioned before, knowing your destination and where you're trying to get to, that is one of the things that keeps you guided and keeps you along the path towards success. And as, different deals, opportunities for buddies come up, there's a certain element of being able to invest in that, and you have to understand the risk associated with it. And does it fit within the plan? Will it completely derail you from reaching your destination? If so, is it worth the risk? Because at the end of the day, it is the client's money, and we're all here to be advisors and provide prudent, thoughtful, forward-thinking advice. But at the end of the day, if they're adamant about doing something of that nature, how does that fit within the context of the plan? And that usually involves a bit of self-prioritization and or awareness of what their goals are.
Excellent, and thank you, and thanks, Peter, for bringing that up, because I think we all get afraid, and sometimes we get greedy. It's natural, we're humans, right? Okay, so Teddy, we've seen a slew of M&A amongst record keepers over the past 5 to 10 years. Why do you think this is happening? And what should committees and plan sponsors be doing if their record keeper is acquired?
Yeah, it's a great question. I think many maybe on the line have experienced that because, back in, I used to work for John Hancock, and I worked for them for almost 8 years in various roles. And towards the end of my tenure, John Hancock announced that they would be acquiring New York Life's record keeping system. And that was a big deal for us at Hancock. Since then, and around that time, we had maybe 80 record keepers in the industry today that would, serviced, the bulk of Americans in corporate retirement plans. There's now somewhere around 30, right? So a lot of that had to do with, fee disclosure rules that came out under the Obama administration. 404A5 and 408B2 basically said that if you were a third party and had an interest or had a fiduciary interest as it relates to a retirement plan and made more than $1,000, you had to disclose what your fees were. And that led to a lot of, fast forward to today or this past year, we've had more lawsuits in the area of retirement plans than we've ever had before, right? So it's a very highly litigious environment for plaintiff ERISA attorneys. So that's a critical thing that happened in 2012, and just the disclosure and unveiling, if you will, what fees are involved with retirement plans. The other thing I would say is margin compression. Through that acquisition, obviously, or through the process of acquisitions, we've seen a lot of margin compression. This is just a very, very tight margin business, right? So either you're going to, invest in the record keeping space or invest in what you believe in. These companies that are out here today, from a record keeper standpoint, also in some cases are insurance companies. So they have other wings, if you will, and how they make revenue and how they generate revenue. So they just needed to figure out, in some cases, do they want to focus on retirement plans or do they not want to focus on retirement plans? So with that margin compression, if you will, it's kind of narrowed it down as to who you should be working with, who you shouldn't be working with. And then from a committee standpoint, if you have been, or worked with a provider that has been acquired, this is the time to kick the tires. It's really important that you start to reexamine, if the acquiring company is a good fit for what you had originally signed up for. Because there's a reason, or should have been a reason, why you decided to go with Empower or Nationwide or John Hancock. That reason may change, right, with that acquisition, with, so-and-so being Mass Mutual being acquired by Empower, or Prudential being acquired by Empower. So it's a great time to start, going through, if you will, your due diligence process as a committee and understanding, does this still fit our objectives? Are fees going up? What type of resources are going to be available for my employees, right? Whenever something like that happens, it's always a good time to do a round, if you will, of at least request for information, right, as to what this is going to look like going forward for your employees.
Excellent, thank you. And Peter, Serena, Marcellus, please make sure you share your information in the chat as we go along, so that folks can connect with you as well. Marcellus, what happens to company stock that an executive owns if the company gets sold or buys or merges with another company? So to dovetail off of Teddy's question.
Yeah, absolutely. Mergers and acquisitions, there's been a substantial uptick in that. There's an unprecedented amount of cash on the sideline, or dry powder, so to speak. So I think there's a lot of private equity firms, there's a lot of companies who are looking for strategic acquisitions or opportunistic buys of companies. And so if you're the company who is selling to another company, your stock, you'll just get cash out. So congratulations. You now have a nice windfall of assets, which, talking with someone like myself, Peter, Serena, Teddy, you won't be involved, unfortunately, because they'll be cashing out the plan. But, we'll be able to talk to you about what to do with those proceeds. If you are buying another company, there's going to generally be little impact. Your stock will remain the same, and you'll just have additional capital assets added to your company's balance sheet. When it comes to a merger, that's when things it depends on who's acquiring who. There could be an exchange for the company stock, and or another consideration is that when that happens or occurs, if you're an executive, especially if you think there are some hires, so you have the CEO, you have 4 named executive officers that will generally be at the top of compensation: CFO, CEO, top 3 highly compensated executives of a company. When that happens and occurs, vesting schedules can be accelerated. There could be maybe some issues to talk around deferred compensation. One of the things I'm sure we may get into is with deferred compensation, sometimes the ability to receive that is on the company remaining solvent and being able to meet obligations versus some contributions that may be your own deferred contributions. So that's a piece to consider. Severance pay, golden parachutes, as we mentioned before, and then non-compete agreements, garden leave, insurance. There's a variety of things that you have to take into consideration when your company is sold, bought, or you're part of a merger.
Excellent. I appreciate that. Was a great.
Mark, I would like to bring up a twist to that, and it is based on personal experience and when a company is merging out. Company would come on the board.
Gary, can you introduce yourself? Thank you.
Oh, yeah. I'm Gary Sock. I've been CFO for many years, but for the last 15 years or so, I've been board member of either public companies or private equity companies. And so I'm thank Mark for introducing me to this group. It's just great. And it's turned out to be a lot more interesting than I might have thought based on the title. But Marcellus, one of the issues I had, and that was that the company I'm on is a publicly traded container leasing company. All of this information was in the proxy, so it's not like I'm sharing anything that isn't public. But what happened is they decided to go and see if they could sell the company. And that was started in December of 2019. The pandemic comes, and of course, we postponed it for a while, but ultimately said, look, we've got to go through with it. So in June of 2020, they gave there was offers. One of the offers was a stock transaction. And so of all the stock options, and I was the longest serving board member, all of those would have been cashed out at the price on closing, but all but one was out of the money. So you got cashed out at zero. And the whole theory of it was, hey, the stock's going to go up when the market rebounds, which it did. So our stock was in around $20, and within a year it went to $40. But we then did another decision to go and sell the company. The valuations you see, they thought they'd get in the mid to high 40s, got a $56 offer. And so now you get cashed out at a much better level. But the swing of getting out of the money cash out of options at zero. And so one of the things I said is give us another year and on the options, but you couldn't. I mean, that was just basically the way the deal was. And they wouldn't assume those options because, normally if you retire, you get 1 year to exercise your options. And in this case, it didn't. So that was one point. I told Mark, unfortunately, I was sort of working two jobs when I was in college. I should have taken the joint MBA JD degree at Harvard, but there was a kind of a money issue there. But yeah, that's what's happened. So that's a big issue, is that if you have restricted stock, obviously, and it gets vested, it's fine, but otherwise you don't. So that be careful of that on a down market, and we probably will have a down market someday, although nobody seems to think so. So, okay, that's just one twist on it there that can be very bad situation depending on when you decide to sell.
Yeah, options definitely, they add some nuances to it because you don't actually own those shares until you exercise it. So just as you put it, if your options are out of the money, unfortunately, you're stuck with a goose egg in that scenario. So yeah, that is something that you hope doesn't happen as much, but it does have the ability to occur in the market.
Great, and folks, please feel free to, like Gary just unmuted himself. If you do have questions, comments, we do want this to be an interactive session, and appreciate you for saying it wasn't boring, Gary. So the more interaction we have, the more conversation. I know a lot of us are on Zooms and just on mute. This is not what this is about. And I have a question from Jared Steffens, who's actually the chair of the Asset Management Special Interest Group. Jared, would you care to ask the question and unmute yourself? And introduce yourself as well, please.
And I appreciate it. First of all, Mark, great job. I mean, these sessions are invaluable. I've attended a few with you, and I always seem to follow up Gary after Gary asks a question, which is a tough act to follow. So it's not easy. For the panel too, thanks for your time. These are areas that I come across quite a bit. I'm a specialty insurance broker at Alliant Insurance Services. So I work primarily within private equity, financial institutions, asset managers, broker dealers. I do commercial as well. I came from Aon and worked there for a number of years. So very familiar with executive benefits, executive compensation, certainly areas that we always, will discuss. I had a question to the group or to the panel, Mark, around executive benefits as it relates to split dollar, life insurance policies. Obviously, the employee and the employer are sharing the cost. I mean, from my understanding, I saw maybe one or two case studies when I was at Aon, but where I guess there's an endorsement from one side, and then there's the other option of, I guess, having a collateral based policy. How often do you see split dollar, or it's not as common with organizations?
Question is open to anyone from the panel.
Yeah, I would tell you I don't see it that often, to be honest with you. I see you look at it and you run some different scenarios, and so I'm not sure. I know Marcellus' firm has this as well. We typically have an insurance specialist who's in-house, and we look at different options for them. And it was funny because kind of going back, I appreciate what you do, Jared, because I remember about 5 years ago, if you're in this business for about 5-6 years, you think you know everything, right? And then I had our insurance specialist come in, and I wanted to kick him out just because I know everything. What are you coming here talking to me about insurance? And then I realized after about 15 minutes of talking with him, oh, he's smarter than me on this, right? He does it all day, every day. So I should probably listen to him. So every time we have a comp where I would say this is a sophisticated insurance discussion, I usually bring him in as well into the conversation because he does it all day, every day. And, I would say it's, having the conversation 15% of the time, it's a good fit because I would say it's probably a good fit more than that. But then there's also a comfort level between the employer and the employee to do this. And so sometimes that comfort level might not be there. And so that's where I say, it probably is the reason why you don't see it done more is more from a comfort level than the economics of it. But that's just
I
my
appreciate
experience.
It. Yeah, and again, from my perspective, again, I'm more so on the risk and insurance side. That's where I'm licensed, and I'm smart enough to know I'm not the smartest guy in the room. I figured that out a while back. Was given that advice, so I'm with you. And again, from my perspective too, I mean, I've been a part of some pretty neat conversations. Also some buy-sell agreements as it relates to maybe smaller, private equity. Marcellus, I see you kind of now. Yeah, that's something that obviously if one partner dies, we know it's there's insurance. I'm assuming tax not there's no income tax paid. Correct on that? Is that correct? Like the buy-sell, Marcellus, or no? I saw you nodded.
Yeah, I was going to say, generally when I'm involved in those conversations, I'm tapping someone like yourself to come in. We only do the investment piece. So we often partner with insurance providers to that. But I believe what you're mentioning is something that is one of the perks of it, but I wouldn't be the one to be able to confirm that.
Okay. Yeah, no, and again, for myself too, that's not me. Again, I'm bringing in someone else, I know enough to touch on it, but that's not my specialty either. This is good. This is helpful. Great.
Excellent. Thank you for bringing that circular point of view to the conversation, Jared. And Jared is recent chairman asset management with the FANG, and he's hosting an event. Jared, if you could quickly let us know about the event that you're hosting a couple weeks or in a week or so.
And thanks, Mark. And Erin Oliveria just dropped. She was on the call too. She's going to be moderating it. So it's a great event. Certainly don't mean this to be a promo by any means, but we're fortunate enough to put together an ESG event, ESG-based event but with a select panel of someone from the investment community, I believe someone from Alliance Global. Then we had someone from risk management that will touch on ESG, marketing and sales. So I think it's a unique, hopefully, panel for everyone to join. And yeah, it's going to be, I think, November 4th, Mark. I don't have it in front of me, 4:30 Eastern time. So yeah, love for you to all join if you can.
Sure. It's in the chat there. So definitely about educating our folks and then, networking people as well. So thank you for that. Okay, great. So Serena, how are you doing?
Doing well. Love your energy.
No, I mean, that's what we're here for, right? Okay, so are there any misconceptions when folks are doing tax planning that you come across? And I'm sure there are. And what are they, and how do you typically mitigate those?
Well, I think for, some people, after December 31st is too late. And so, you remember that you can contribute to your 401k, your IRA or your Roth IRA, or you can start an employer plan if you're a startup business after December 31st. But everything else has to happen before December 31st. And so for a lot of people, they start thinking about taxes in, maybe March or April, but you really need to be thinking about taxes in, November, December. And so thinking about setting up those donor advised funds, exercising your stock options, maximizing your 401k or contribution plans. Also, you can maximize your HSA or FSA plans as well. And so there's some benefits, on that side if your employer is doing any sort of matching. You can do your Roth conversion. So sometimes, Peter and I are working with those that are nearing retirement. So if you're 59 and a half, you can do an in-service distribution from your retirement plan and, roll that to an IRA, and then you can do a Roth conversion. So that can be something if you know that you're not going to spend all of this in retirement, and you know that you're going to gift some of this to your children. If they have to inherit all taxable assets, that can really be a hiccup on what they do inherit. And also it brings up their tax bucket. Because as we know with the Secure Act, I think Teddy talked about that earlier. One of the things with inheriting IRAs is that now they've got 10 years to pull all that out and pay taxes on it. Before, you could stretch it out over your lifetime if you inherited mom or dad's IRA, but no longer is the case. So they give you 10 years. But if you did a conversion and converted a portion of that over time to a Roth, they don't have, those same rules of paying taxes. There's no taxes owed on a Roth, and they can continue to stretch that out to the grandkids over time. So there's just some tax planning strategies that can be done, but they have to be looked at. And, really you want to start talking with your advisor or your partner or your professional around November, December, and maybe even early in the year, and get a plan of what you're going to look at in November or December.
Great. And what can you do after the 31st of December, if anything?
So that's where you can set up your education savings plans. If you are looking at doing college planning for your grandchildren, you can do your Roth IRA contributions after December 31st. Also look at your beneficiaries. If we do find this from time to time where someone was divorced and their ex-spouse is still listed as a beneficiary on all of their plans. So look at your beneficiaries. Do look at your insurance as well. Make sure that that's adequate for what you're trying to accomplish, whether it be health insurance or life insurance.
Okay, great. Thank you. I appreciate that. And so, Marcellus, what steps should an executive take when planning for retirement?
Yeah, I think we hit on some of those key things there. You definitely want to update your personal balance sheet, taking a look at what outstanding liabilities are out there, the assets that you have, both liquid and illiquid assets, real estate, maybe investments in private equity opportunities, or, those garage capital opportunities. And then you want to take a good thought about what will happen in the next phase of your life. It'll be a career transition. It's a life transition. And so figuring out, what's important to you, whether it's travel, whether it's spending time with the family, serving on boards and receiving income into that, as you approach retirement, looking at what you may have in deferred compensation, understanding when those items would come due and how that would work from an income tax perspective. And generally speaking, and Peter and Serena both being at Wells Fargo, if you need to establish lines of credit or refinance while you have documented income that's already established, now that period of time may be a good time to look at doing a home equity line of credit or refinancing a mortgage or whatever when you have that stable income coming in, versus if there's going to be a significant reduction in retirement, you may not get as much capital or the availability to spend as you would have liked to have had going into retirement.
Excellent. That's a great answer. I appreciate that. So Teddy, what's the hardest part of your job as it relates to interactions with participants in retirement plans?
Yeah, that's an interesting question, Mark. I mentioned before that I worked at John Hancock as what they call a regional account manager, and part of that job was going in once or twice a year and meeting with employees at from a group perspective, and then also on a one-on-one perspective. And I would say the hardest part is really getting folks, especially if they're early on in their career, to see what they're going to look like at 50 and 60 and 55, right? So it's hard to have that perspective when it comes to retirement planning at such a young age, right? So I think the industry as a whole has done a great job of coming out with tools that focus on, what your income will look like if you make a conscious decision today to put away, 7 to 10 to 15% of your income, whatever that is, whatever makes sense for you, and what that's going to look like when you're 60, right, from an income standpoint. So that's the hardest thing, is to get folks to think about, when they're ready to hang it up or don't want to work as much, how much money they're going to have and what type of lifestyle they're going to live. But like I said, we've done a great job in our industry of, at least in recent years, of coming up with tools and resources to help people actually see that, yes, if I increase my contribution by 1% for the next 4 years, that's going to mean $30,000 more in income by the time I'm 72, for example, right? Those are real life examples. And I think when I started in the industry, it was, that wasn't necessarily the focus. The focus was just telling folks to put away as much as you can and try to put away 10%. And we're trying to get 10 times as much as what your income is in your account. And that's unrealistic, but you're still telling them that. So anyhow, that's the hardest part, but I'm really encouraged to see where we're going.
Interesting. Marcellus, how can one incorporate philanthropy in their goals and gifting?
Yeah, I think a lot of people overlook gifting, being able to do the 15,000 exclusion on an annual basis per individual. That's the first step. And then if there's going to be excess capital, utilizing things like a donor advised fund, a charitable remainder trust, setting up maybe a private foundation if it makes sense for your family. Those are ways that you can incorporate that into gifting.
Excellent. Serena, what are your thoughts on the same question?
I think that, there's also other ideas like the HSA I mentioned earlier. So something I think Peter and I have done this presentations, it gets often overlooked. If you've got a high deductible health plan, you can maximize your HSA contributions. I think it's $7,200 for families. Something that's a good benefit before you get ready to retire is those HSA plans can go with you in retirement, and you can use them to pay for medical costs. One benefit that I see a lot of retirees use is they can also use those to pay for long-term care insurance. So Peter and I use this as a planning tool. You can You know, back in the day, it was only kind of the pay and use it or lose it plans. But today they've got life insurance plans with long-term care riders. So it's a win-win either way. If you need long-term care, you know, you need somebody to come to your house to help you later in life, or if you want to go to a facility and you need that assistance, or if you live till 99 and you never need assistance, you've got a death benefit that goes to your heirs, and you can use that HSA account to pay those premiums. And the good thing is if it's used for medical expenses or used for long-term care insurance, there's no taxes owed. So it's kind of like a Roth. If you don't qualify for a Roth, you can use your HSA as a Roth account. So that's, you know, just a tip that I find retirees just don't know about, or executives don't know about, you know, having that high deductible health plan.
Excellent, superb. Teddy, ESG, environmental social governance, is a huge topic of discussion for organizations in our society. Are plan sponsors inquiring about adding ESG funds on their investment menus? You're on mute. You're on mute.
Thanks, Mark.
No worries.
Like I was saying before, we're starting to get more and more clients asking about that. It's not the first thing they want to talk about. It's usually like the question you asked before, financial wellness or cybersecurity. Talk to me about that. Educate me about, you know, what I should be asking my providers and what type of financial wellness programs. But ESG is coming up more and more. Long story short, from a Department of Labor standpoint, an SEC standpoint, they're kind of mute on this, right? They've given some guidance, you know, going back to 2018, and the Trump administration, generally speaking, wasn't too fond of it, and they held it up and wanted more review on it. The Biden administration seems to be a little bit more open to having plan sponsors take a look at that, right, and qualifying that for participants. So this is always you know, when we talk about ESG from a consultant standpoint, there's the plan sponsor employee view, all in one. I'll put them all in one bucket. And then there's as a fiduciary, how are we supposed to look at this, right? The plan sponsor employee view is really that we have an aging working population, right? We have folks that are, you know, as I mentioned earlier, 10,000 folks a day that are turning 65. So that transfer of wealth that's happening is a big deal. Then we have millennials that are coming in and starting to kind of hold that C-suite position. And they're the ones that are pushing this type of conversation, right? Because they're now in leadership. The question from a fiduciary standpoint is, well, how does that fit the criteria, the investment policy, right? It has to obviously pass your screening process, right? There's a quantitative and a qualitative screening process in order to actually offer a fund that's, you know, that's going to be able to provide performance and consistency over a long period of time. That's the goal, right? So, and a lot of times that may conflict, right? The fact that you want funds that don't, you know, that don't have anything to do with pollution and you know, all that's going on the environmental front, but you want funds that actually maybe also don't do business with Iran or Pakistan and things of that nature. It's a very complex subject when it's all said and done. But if you're working with a professional or consultant team like I am, there are a number of resources out there to help you kind of understand where a particular fund is and what type of decisions that a particular investment manager has made as it relates to ESG. We're early on in that process, if you look at it from a baseball analogy, but you know, hopefully we'll get some more guidance. I think in the next couple of months, we're expected to get a little bit more guidance on how we as fiduciaries are supposed to position this for our participants.
Superb, fantastic. And so we're going to wrap things up here. And so first of all, I'd like to thank my speakers, Teddy, Marcellus, Serena, and Peter. And then I'll ask you to give me just a brief, 30-second, just best practices or summary of your thoughts. So Peter.
Thanks, I appreciate it. No, I think we've said it once, but I think it always says again. I think every dollar should have a purpose. I think that what our grandmothers sometimes teach us was the best advice. And so every dollar you have should have a purpose and understanding what you're trying to accomplish with that, and having a plan set together. And I think sometimes we focus only on investments and we don't talk about some of these other things that I think are very important, such as healthcare costs and retirement. I'm not saying that you need to go get a long-term care policy tomorrow or anything like that, but I'm saying you should have a plan for it, a written documentation. And what's interesting to me is how many times we've done, I would call it couples therapy, because when we actually have these conversations about outside, it's the first time they've had the conversation. They've been married for 40 years and they've never had the conversation about, hey, how are we going to pay for healthcare and which kid is going to take care of us if we need some help? You know, they answer at the exact same time with two different names. And so having a conversation and sitting down and going through this process, and this starts well before you retire. This starts while you're going through your career and through the 40s, 50s, 60s, peak earning years, and then afterwards where you can enjoy life. And so, like I said, our goal is just to allow our clients of the one life that's God's given them the best they can without undue risk or financial stress. And that's what we try to do every day. And I hope today was helpful for everyone who attended, and it was enjoyable.
Excellent. Serena.
Well, I just want to say thanks for having me, Mark, and putting this on. My tip or leaving thoughts would be to continually educate yourself, which everyone seems to be doing here today, and taking in more knowledge and, applying that knowledge to your business, or, hiring a counselor, consultant, bringing some questions back to your financial advisor. If there's something here today that you learned that you didn't know about, and asking them, how can you apply that to your plan? So just continually to educate yourself and join as many opportunities as you can to know, because there's, as Teddy and Marcellus have mentioned, there's a lot going on with the Secure Act, the American Rescue Plan Act that came out with ERC credits, for employers. So just continue to do that. And thanks again for the opportunity to speak today with everyone.
Superb. Thank you very much, Serena. Teddy.
Yeah, I'll try to keep it really quick here. But first and foremost, thank you for having me, Mark. Thank you for the FANG for having me as a panelist here. With that being said, my closing remarks really center around, understanding what's most important. From my perspective, is really helping employees be ready, right? Be more ready for retirement. And the biggest factor in that entire conversation is really how you design your plan. So go back, take a look at how your plan is designed, make sure that folks are incentivized to put away as much as they need to put away, if you will. And yeah, that'll be my closing remarks.
Excellent. And last, definitely not least, Mr. Marcellus. Looks like he disappeared. He did disappear. Okay, perfect. Well, thank you, ladies and gentlemen.
Mark, before you leave, I'd like to add one question, which I think would be good for a future topic and for all of the advisors here, and that is the effect of the current proposed taxes that are going on. Now, a couple of hours ago, before we got on this thing, I looked at Bloomberg, and they're talking about the wealth tax raising around $400 billion, 250 billion or so just from the excess Medicare tax. Now, right now, the market's booming like crazy. California, something like 20–30% of their budget comes from all the massive amount of income from vested restricted stock or stock options, or massive bonuses that people have out. So what happens? First of all, Bernie Sanders and Elizabeth Warren are licking their chops. Boy, we can put all these entitlement programs in. The child care tax credit, for instance, is $250 billion a year. Now, whatever you think about it, what happens when the stock market goes down? Okay, so we get suddenly a drop of 20–30%. These revenues can drop 50% in terms of that, or even more. Or in the wealth tax, they talk about a refund. So suddenly you have a big hole in the tax revenues, but you've got what will likely be permanent entitlement. So that's going to be a big thing. And so, we have 12 billionaires in Los Altos Hills. I was talking to one of them, although I think he's not a billionaire today, but the stock dropped a bit. But, he was offering to buy me coffee, and he says, and so I'm telling him about the fact that, this $100 million a year in income, might go down to 10 million if there's a drop, because they got to raise some revenue. So anyways, in the end, he still did buy me the coffee. But what happens is I think what you have to worry about is these numbers at high numbers that people will start putting in entitlements, and it's very volatile. California being an example. Restricted stock is extremely volatile in the income that California has from it. And the same thing for big bonuses and stock option exercises. So it's a little tricky. I don't think those numbers are going to come here. I don't know what happens in a time when you're planning for retirement. Salt's another one. Look at salt. They're talking about getting rid of salt. So if you have big income this year, you're limited to 10,000. The Democrats are talking about eliminating salt for 2 years. So that's going to be a big hole in the budget. But then remember, under the tax plan that Trump had in 2027 25, it comes back again. There's no limit. They're now saying we're going to extend that 10,000 limit for 4 years. So therefore, you see all this money coming in. But of course, it's not going to go back that way. So there's a lot of tricks being played with this budget to try and get it under the reconciliation rules. Watch that closely, guys. That could be a topic. You could have a real good topic on that. Maybe we have to wait till it gets solved. But I think that's going to be very tricky, especially when you're tax planning and when to take income. In my case, we're having a merger this year, so there's nothing I can do about it. I think there's several $100,000 of state tax in play, depending on whether or not the salt gets unlimited this year, which it doesn't look like it's going to happen. So, okay, but great job, Mark.
Thanks, Gary.
Thanks for your comments. And next time you're having coffee with your buddy there, let me know, and I'll be joining you. Your billionaire buddy, and maybe Peter.
Well,
Serena.
I think these guys are inflated. It's like, but okay. Thanks a lot, guys.
No
Thank
worries.
you.
Thanks,
And
Gary.
I think, Marcellus, did you? Okay,
Not sure what happened, but I dropped off. Basically, know your plan, know the benefits, know the rules, and make sure you take advantage of what's available to you to meet your long-term goals. So that would be my takeaway.
Excellent. I thought you did an Irish goodbye there. All right, well, okay, folks. Well, appreciate everyone. And once again, we want to thank the FENG Financial Executives Networking Group. My name is Mark Hamza-Rabogbo, and I am chairman of the Capital Markets Special Interest Group. And we look forward to seeing you on our next session. Once again, thank you to all my speakers. This was a very enlightening and engaging session. I really, really appreciate you all. Thank you.